Hello everyone, thanks for coming, and today I would like to give a review of the last part of the chapter, multiple state models. First, we discuss the multiple decrement model, where we can go from one state to many other states. So in a general multiple decrement model, it contains n plus 1 states. State 0 is the alive state, can go to any of the state 1, 2 to n and stay there. So probability of staying at the state 0 is e2 minus integration of all or of the summation of all transition rates out of state 0. The probability of going from state 0 to state I is the integration of the survival probability at time s times the transition rate at time x plus s integrated over s. Then we have the joint line models for two persons, usually a couple. We have many states. 0 is the state when both lives are alive. 1 is husband alive, wife dead. 2 is husband dead, wife alive. And 3 is both dead. So we have several notations. The important notations are T, Q, X, Y, 1, which means X dies before Y and within T years. T, Q, X, Y, 2, which means X dies after Y and within T years. T, P, X, X, Y bar is the case when at least one of the two lives is alive. So it is a summation of both are alive plus the wife is dead but husband is alive plus husband is dead but wife is alive. So T, Q, X, Y bar is the probability that both are dead in T years, which is the transition probability from 0 to 3, the case when both lives are dead. We have insurance functions for the joint life case and last survivor case. So A bar XY is a joint life annuity, X is a husband's life age, and Y is usually the wife's age. This pays until the earlier death of the two lives. So if the husband or wife dies first, the annuity will not pay after that. A bar XY is a joint life insurance. It pays a lump sum of money when the first death happens within the two persons. So whoever dies first, the insurance will pay a sum of money. A bar XY bar is a last survival annuity. So it will continue to pay until the later death of the two lives. So even if one of the husband or wife dies, the annuity will still pay till the later death. Capital A bar XY bar is a last survivor insurance. It will pay at the later death of the two lives. So if both are died, then it will pay immediately. So in reality, we often have some annuity which pays a fixed amount when both lives are alive, but it will pay a reduced amount when one of the two lives passed away. So it can be seen as a combination of the joint life annuity and the last survivor annuity. So an important special case is a case when the survival models are independent for the husband and the wife. So in this case, the survival probability is the product of the survival probability of the couple. The joint survival probability is the product of the survival probability of the husband times the and the survival probability of the wife. In reality, we have pension plans where annuity will be paid after retirement. So in this case, transitions happen at specified ages, let's say at 60 or 65 years old. So the premium will be paid until the death of an employee or until the retirement of an employee. The retirement happens only at discrete specific ages. So in this case, we usually have a combined model. The company pays the premium for annuity of the annuity for the employee as welfare, but the employee can withdraw from the company at any time. This process is continuous. But also, at specific ages, the employee can retire at those ages. The retirement happens only at discrete specific ages. We will have a more complicated model than the continuous transition model in this case. Thanks for coming.